Well, hello and a very warm welcome to this webinar, Key Economic Opportunities and Challenges in Central and Eastern Europe and Western Bank Strategies in the Region, brought to you by Scope Ratings. My name is Keith Money. It's my pleasure to be your moderator for today's session. And I'm delighted to be joined today by analysts from two of Scope's rating franchises. So let me introduce you to Milya Safiullina from the Financial Institutions team and Jakob Suwalski from the Sovereign and Public Sector team. In a moment, they'll each present some top-line thoughts from their respective areas. Jakob will cover macroeconomic topics, including, as I said, principal challenges and opportunities, while Milya will discuss the strategic case for Western European banks in CEE. After that, we'll move to a Q&A. So please do type your questions into the questions box and we'll address them at the end. Today's presentation slides will be available for download at the end of the session. I'll explain how to do that later. Please note, in the interest of time, we won't discuss aspects of individual economies in depth today, but if you have questions on aspects of each country, do type them in and we'll circle back to you one-on-one. So that's it from me. Milya, Jakob, it's great to see you. Jakob, I believe you're going to start, so let me hand over to you.
Thank you very much, Keith. So today, we begin by examining recent economic developments and the outlook for selected 11 CEE economies, all of which are EU members. And for these countries, we project real GDP growth on average to increase to around 2% this year, so bouncing back from 0.4 last year and further rising to a range of 2.5% and 3% next year. The drivers behind this growth across the region include lower inflation, rising real wages, and decreased interest rates. These factors are all bolstering private consumption. Public investment will be the second largest growth driver. And however, despite these positive factors, the contribution of exports to growth is constrained by weak external demand, like, for instance, coming from Germany. The growth across the region is diverse. So with Croatia, Romania, and Poland forecasted to have the highest growth rates this year, ranging close to their potential. Conversely, Estonia is expected to remain in recession this year. This is a result from negative carryover effects from last year and only gradual improvements in the economic momentum. Also, the Czech Republic is forecasted to grow by only 0.6%, indicating a more delayed recovery compared to the other countries. However, we anticipate for both countries to experience growth of around 2% next year. In general, the more export-oriented countries like Hungary, the Czech Republic, and Slovakia, which have strong but energy-intensive manufacturing bases and which are highly integrated with global supply chains, are more vulnerable to spillover effects from developments in Western economies. And the economic outlook for these countries is therefore more sensitive to potential supply disruptions and fluctuations in energy prices. Overall, CEE economies continue to be heavily reliant on energy, which means there is a substantial price or expense associated with converting energy into GDP. So this will make emissions also more costly going forward. And then finally on the slide, looking briefly on the external positions, most CEE countries experienced a decline in their current account deficits last year. And the improvement in terms of trade resulted from reducing the reliance on Russian energy, leading to lower prices. And this shift is a structural one. It will persist this year, despite countries like Hungary, Slovakia, hesitating to seek alternative gas sources. In addition, export performance remains sluggish, so we expect the current account balance to remain at around minus 1% of GDP whereby Romania and Slovakia are expected to remain relatively high deficits this year, whereas Croatia, Slovenia are projected to achieve large current account surpluses. And as investments were postponed in the previous year due to the tightening financial conditions, we expect now that together with income, FDI and EU funds, these will also enhance the external deficit financing in the region. And the upcoming slide delves into inflation trends and central bank policy rates, which are crucial indicators for assessing the investment environments, but also bank performance. And inflation across the region has been decreasing from high levels, but it is projected to remain above the central bank target this year. So we forecast the CEE 11 region will see an average headline inflation rate of around 3.5% this year. This is down from around 10% last year. However, across the region, core inflation remains elevated. This is due to price indexation in specific sectors, higher labor costs, and these reflect the region's tight labor market. Energy and food prices are volatile, but it is about the real wage growth and the robust domestic demand recovery, which may sustain elevated core inflation going forward. So the inflation scenario also differs among the countries, but in general, we expect in the short term an uptick in inflation in the second half of this year. So to the difference, for instance, last year, Hungary recorded the highest inflation, peaking at 26% in January. There were price caps curbing inflation in 2022, and their removal added to inflation in 2023, as did expansionary budget policies, but also currency devaluation. So for most countries in the region, as I said, we expect an uptick in headline inflation in the second half of this year due to factors such like diminishing disinflation, driven by base effects and the rapid increase in service prices, higher labor costs, and also due to higher oil prices. The trend is already visible. For instance, this year, comparing March and April data, for example, in the Czech Republic, inflation reached the target of 2% in March, but accelerated to 2.9% in April. Additionally, given the volatility of food prices, along with the planned removals of price caps and tax exemptions introduced during the energy crisis, this suggests heightened uncertainty in terms of inflation forecasts. And the implications for the policymakers and the central banks in the region stemming from these trends are diverse. So central banks in the regions, which have earlier began to raise interest rates compared to the euro area, may need to calibrate their policy stance to manage inflationary pressures while supporting economic growth. For instance, in Poland, there has been a shift in the Monetary Policy Council's reaction since the October elections, moving to a more neutral position, suggesting that interest rates will likely stay unchanged due to the persistent core inflation. And policymakers in the region may need to implement structural reforms aimed at addressing the underlying drivers of inflation, such as labor market dynamics. Prolonged high wage growth and elevated core inflation may affect the competitiveness of CEE economies in the global market, and therefore potentially also impacting export growth and trade balances. And as the flexibility for policymaking also depends on the availability of fiscal space and debt affordability, I will conclude on the macro environment with our views on the public finances in the region. The combination of high inflation and interest rates has created financial challenges for the sovereigns, and this has led to elevated budget deficits. The tax revenue growth remains limited by the supportive measures still in place aimed at addressing the energy crisis, and coupled with higher interest rates, still high interest rates, also inflation, driving up pension expenses, budget deficits will remain high this year, ranging, for instance, from 5 to 6% of GDP in Hungary, Poland, Romania, and Slovakia. These countries are unlikely to bring deficits to the Maastricht limit, 3% of GDP, also next year, given their high interest payment burden. And longer term, there is the significance of defense spending due to the war in Ukraine, and the need for investments in alternative energy infrastructure. And these are adding longer term other dimensions to fiscal considerations. And we expect that more ambitious consolidation plans will materialize next year. So the probable inclusion of Hungary, Slovakia into the excessive deficit procedure alongside Romania may further prompt these efforts. And on a positive note, most issuers in the region have front-loaded their debt issuance this year in Q1 especially, and this has partially mitigated the risks associated with higher financing, higher budget deficits for this year. So CEE sovereigns in general advanced strongly in their borrowing plans and have benefited from investor demand for emerging market assets, and have across the region borrowed more than planned, both domestically and externally. So for example, in Hungary, Croatia and Romania, most of this year foreign issuance has been finalized, whereas also Hungary modified its financing plan at the beginning of April due to a higher budget deficit, and Slovakia has already met its full year borrowing targets. To conclude the slide, looking ahead, the still high borrowing costs in this year will compound the difficulty of managing budget deficits, especially for those countries with relatively higher borrowing needs and shorter debt durations. So we expect net interest payments to become a heavier burden in the region. They will increase from an average of around 2.5% in 2022 to 3.5% this year, and further climbing to almost 4% by 2026. And here Romania was projected to bear the most substantial interest burden, reaching nearly 10% of revenue by 2026, followed by Hungary with nearly 8% allocated for interest payments. And now that we have examined the macroeconomic complexities facing sovereigns in the CEE region, let's turn our focus to how these factors intersect with the banking sector. Milya, our financial institutions expert, will shed some light on the strategies for banks operating in this environment. Milya, please.
Thank you, Jakob. The CEE banking sector continued to grow strongly as demand for banking services develops in parallel with higher living standards. When evaluating the long-term strategic drivers of Western European banks, presence in CEE, three elements stand out: growth optionality, high profitability, and diversification. From a diversification perspective, being present in CEE can add stability to the performance of Western European banking groups, because CEE and Western European economic cycles are not fully correlated. The solid growth expectation for CEE just presented by Jakob contrasts with the sluggish area economy, which scope projects will grow only just by 1% this year and 1.8% next year. In recent years, CEE countries have shown a remarkable move towards higher banking penetration. This trend is said to be continued. Romania, Serbia, Bulgaria, Bosnia, Herzegovina, Albania have highest potential for catch-up here. Poland, Hungary, Croatia, Lithuania, Latvia, Slovakia form a group with medium penetration. The Czech Republic, Estonia, and Slovenia have more advanced banking penetration. However, even these latest countries remain significantly underbanked compared to countries in Western Europe. The economic and political landscape also determines the concentration of foreign players in the CEE countries. Since the early 2000s, CEE banking sectors have undergone an accelerated process of concentration and foreign penetration. With the exception of Hungary, Poland, Estonia, and Slovenia, which maintain a solid share of domestically owned banks, the rest of CEE banking sectors are for most part foreign-owned. CEE positively contributes to the diversification of revenue and earnings streams for a number of Western European banks, an element generally supporting their credit profiles. However, strategic approach to the region varies across groups. Erste, RBI, KBC, UniCredit, and Intesa have developed comprehensive regional strategies with a broad presence throughout the region. RBI, Erste, KBC, BCP, Swedbank, and UniCredit have a large share of revenues coming from CEE region. Other large Western European banks such as BNP, ING, Santander, BCP, Commerzbank, and Crédit Agricole have a more focused presence on Poland, the largest banking system in the CEE region. And the Nordic banks have a strong focus on the Baltics. Compared to Western European banks, groups with CEE presence usually display better revenue generation and bottom line performance. This is because CEE markets offer high return potential for banking groups invested in the region. This is due to high interest rate environment and stronger economic performance during the last year and in the coming year. However, being present in CEE comes with risk naturally associated with banking in less mature markets, notably political and legal risks or geopolitical tensions. The introduction of extraordinary windfall taxes to finance public expenses in several countries of CEE region, or interest rate caps in Hungary on certain loans, credit holidays on FX-denominated loans in Poland, are the example of recent government intervention. So policy uncertainty weighs negatively on our assessment of the operating environment for banks in these countries. Despite slower lending activity, profitability at CEE subsidiaries reached record levels in 2023 due to high interest rate environment and benign risk environment. There are also measures to reach cost efficiency amid high inflation, while digitalization drives reduction in network footprint. Although NPL levels in CEE are generally elevated, higher risk appetite is compensated by higher returns. We believe weaker asset quality compared to Western European banks is mitigated by higher margin, allowing higher risk costs to be absorbed. However, stronger capital markets are also very important to offset high credit risk. Capital adequacy last year remained sound despite ongoing geopolitical turbulence and increased requirements in CEE countries. I will stop here and maybe give more details during our Q&A session. Hand over to Keith.
Okay, that's great. Thank you very much, Jakob and Milya, for your comments. Let's just minimize that for a second. So I've collected some questions here, and we are going to go a bit back and forth between banking and macro, and so hope our viewers will bear with us. So I'll kick off with a couple of economic questions, and then there's some banking ones that I'll put to you, Milya. So Jakob, I was just thinking about what you were saying, and there's a question here about the kind of, I guess, lack of synchronicity between the European Union and some of the CEE economies, which appear to be at different points in the growth and monetary cycles. So we've got growth expectations in CEE running ahead of the European Union as a whole, and some central banks, as you mentioned, have already started to cut rates, and others are expected to follow. I guess a very broad question, but how do you perceive this lack of synchronicity between the EU and the CEE region as a whole?
Yeah, thank you, Keith. So the different points in the growth and monetary cycles between euro area and the non-euro area in the region, first of all, can be attributed to several factors. So central banks in the CE region began raising interest rates earlier in response to the energy crisis, where they were hit harder. This has resulted in significantly higher rates compared to those in the euro area, and specifically looking at the spread between the interest rate for end consumers, such as consumer credits or overdraft facilities for corporates. They remain notably wider in CEE countries compared to the euro area, and this disparity in interest rates makes FX financing more attractive for businesses operating in the region. And we believe this was one of the reasons why there has been also such a surge in FX issuance in the first months of this year in the CE economies, which in turn weighs on the debt profile insofar that it's loaded more with FX risks. So we can say for sure also euro area membership supports strongly the stability of exchange rate, but also has improved the predictability and the transparency in price setting. One could make this comparison, and this is why euro area countries in the region in particular benefit from increased resilience to external shocks. So there are these two disparities. I think you're on mute, Keith.
I'm on mute, okay. So where does the region stand, Jakob, on debt sustainability and government debt trajectories?
Mm-hmm. So with budget deficits remaining high this year and narrowing only partially next year, public debt will continue to rise as a percentage of GDP and trend. However, most countries in the region have a moderate debt level of below 60% of GDP. The exceptions are Hungary, Slovenia, followed by Slovakia, also Croatia. And of these four countries, maybe only Slovakia should see public debt materially further rise over the next years. But for the next years, we also expect more fiscal tightening with tax increases and reduced energy subsidies. And this is an important factor we will look at, and we made some calculations also. So, for example, the removal of all price caps on food could help in particular Poland and Romania to decrease their budget deficits, which would have a positive impact. Whereas in the case of Hungary and Slovakia, we expect that fiscal adjustment will be slow, as it's likely that most subsidies will be maintained in these two countries. And this would mean that, for instance, Hungary would require a substantial primary surplus to achieve a budget deficit below 3%, which seems unlikely. Therefore, also Hungary's budget deficit is expected to remain elevated compared to the other countries.
Okay, thanks. Moving to banking, Milya, there's a question. You mentioned in your comments that Western Bank CE subsidiaries made record profits in 2023. I guess the big question is, can that be sustained?
Yes, thank you. Really, record profitability seen at CE banking subsidiaries last year may face challenges in sustaining in such elevated levels. The current interest rate environment has supported the bank's net interest margins, but we already see rate cuts. Another thing is that banking sector is tied to economic performance. While last year saw robust economic growth, and this year also looks very promising, in the future, economic condition could be not so favorable. Uncertainties, which already mentioned Jakob, could impact economic performance and profitability of banks in this region. As well, regulatory changes or changes in tax requirement can also influence profitability. Increased government interventions or potential changes in capital adequacy requirements also may put pressure on banks' bottom lines. What else? Banking sector in CEE is becoming increasingly competitive with both traditional and fintech disruptions, vying for the share in this region. This could influence also the margins and also influence the level of profitability. The quality of assets, of course, is also very important. In case of significant deterioration of loan portfolios, increase in NPL levels, this also can be very negative for profitability. In our opinion, CEE banking subsidiaries to sustain still so elevated levels will require navigating these and maybe other challenges effectively.
Yeah. Okay, staying with you, Milya. Again, there's a question about, I guess, following on from what you just said, downside factors and challenges. I guess some people might be surprised to hear the notion that having a presence in Eastern Europe for Western banks is a source of credit strength. But there are downside factors and challenges that Western European banks do face in this region as a whole, which they may not face in their home markets in Western Europe. Can you just talk a bit about the downside factors and challenges?
Yes, I will concentrate maybe on the most visible, the most clear. Exposures are most sensitive to economic headwinds, and while asset quality improved over the last 5 recent years, it is more sensitive to economic downturns. Under an adverse scenario, CEE exposures would experience the higher percentage point increase in default compared to Western Europe. As well, high exposure of CEE banks to home sovereign also makes banks sensitive. Higher performance volatility, weak rule of law, government intervention, and higher level of corruption remain among major tail risks in this region.
Yeah. No, absolutely. And Jakob, back to you. Still on this issue of challenges. It's a very broad question, but can you talk about some of the key political challenges that the regional economies face, and what are the main political and geopolitical risks to the growth outlook? So if you can try and summarize all of that into a sort of brief answer.
Yeah. Okay. No, interesting. Thank you. So I would mention first a key risk scenario would be a favorable outcome for Russia in Ukraine. This scenario could lead to heightened risk premiums on CEE financial assets, particularly probably in the Baltic states. Another major political risk is refers to global trade policies. So for instance, increased trade protectionism, as currently observed, typically reduces risk appetite for emerging market assets, thus impacting small open economies in the CEE. And this could also occur depending on the outcome of the general election in the US by the end of this year. I think also most of the CE countries aim to secure funding before September this year, also to mitigate potential price volatility associated with those elections. So this is a point to observe. And another political risk for the region is the overall only low reform momentum for most countries in the region. So there is a risk that this trend persists in those countries and would potentially lead to adverse effects on budget deficits. And finally, I would mention the remaining risks of materially lower EU transfers funds to Hungary, but also Slovakia, amid standoffs with EU institutions.
Yeah, okay, absolutely. So back to you, Milya. So moving away from challenges, perhaps opportunities, and you mentioned that Western banks see subsidiaries have made record profits, and you've talked about the sustainability aspects of that. But Western banks have identified the region as a source of growth. And a very topical factor here is some have actually increased their footprints recently, or are in fact in the process of doing so through M&A. Do you expect that trend to continue?
Yes, the answer is yes. Western European banks remain undeterred in their strategies and exposure to CE markets beyond Russia and Belarus, and revived M&A activity, especially in Romania, Hungary, and Serbia last year, by major players like Intesa, Unicredit, Erste. This all demonstrates their intention to capitalize on growth opportunities and bolster portfolios. At the same time, citing a lack of scale, some Western European groups announced withdrawal from certain CE countries, for example, OTP or BNP did in Romania. We expect further consolidation in CE markets. This is given regulatory pressures, digitalization, cost efficiency necessity, margins challenges, and new bank taxes, all of which are impacting profitability.
Right, absolutely. Okay. We've just got a question come in, which I'll mention, but I suspect we may have to circle back to our question, Milya, which is the situation regarding residential and commercial real estate affecting banking sectors in the CEE. The question is really about which countries do you see the most potential for banks? In which countries is the market too concentrated? Unless you have a ready answer for the CRE residential real estate question, perhaps we can park that one for the time being, and perhaps we can circle back after the session to our questionnaire. But yeah, so thanks for the question, though. So one of the questions, I guess, that is again topical but very political. So I'll ask this with some hesitation, Milya. There's been a lot of coverage about Western European banks' exit from Russia, and I guess the case that's in the news most particularly now is the case of Raiffeisen Bank International. And I was very taken with the chart that you showed in your presentation, showing the proportion of RBI profits that come from this region. So can you just give a general view on on this topic?
Yes, the conflict has cast some uncertainty on the strategies of foreign banks in Eastern Europe. Few have managed to diverse from Russia, and some with significant losses. Unicredit, which is heavily exposed in Russia, is hastening its withdrawal from the country, despite its solid profit in the first quarter 2022. 2024. Of course, RBI also considering an exit. This is evidenced by reducing its lending activity and the announced planning sale of Belarus unit. While its Russian subsidiary remains highly profitable, ongoing reputational and legal risks amidst international sanctions are prompting cautious deliberation. The latest collapse of the Strabag deal means that RBI will have to find new solution, another way to repatriate capital from its Russian subsidiary. In our view, this is becoming increasingly difficult. Though from a positive side, we can point that withdrawal from Russia can open new opportunities for RBI in other CE markets. This is also positive from our side, from our point.
Yeah, absolutely. And Jakob, I guess two questions in one, if I may, which is about private consumption and export demand. So you mentioned that the principal growth driver in the region is going to be private consumption, but at the same time you point to tight labour markets. So the first question, I guess, what are the main structural factors behind this tightness and the differences to Western advanced economies? And perhaps you can follow up with, if we do continue to see lower export demand, is that a concern?
Okay, no, thank you. I will combine this. So consumer spending bottomed out already last autumn. At the same time as real wage growth was turning positive in the CEE countries. And also despite weak economic growth last year, marked by also poor foreign demand, wage growth remains resilient due to the tight labor market conditions. The main structural factors behind this labor market tightness, but which are also valid for Western advanced economies, are aging and skills match. So aging, which will intensify to the end of the decade, especially a concern in Poland and Romania. And then generally skills mismatches, which will be unlikely solved as education systems fall, according to surveys in CEE, more and more behind what is required by companies with their evolving needs. There are also specific structural factors in the CEE, I would argue. One is labor immigration, and the second is low domestic labor mobility. So labor immigration, this remains a bigger issue in Bulgaria and Romania, and the low domestic labor mobility compared to Western advanced economies is due to weaker transport infrastructure, and the second factor is a high share of owner occupancy in CE housing, which makes the labor force less mobile to what is typically available in Western advanced economies. And if the lower export demand is sustained in the medium term, that would be a concern for the region. For instance, economic dependence, as many countries in the CE region depend on exports to drive economic growth. This would, I would argue, disproportionately affect the smaller, more open economies in the CE region, those with closer links to specific industries. For example, Slovakia, Czech Republic, and Hungary have strong ties to the automotive industry. This would likely face significant challenges to decrease demand for automotive exports, and these countries rely heavily on a functional supply chain, which makes them vulnerable to fluctuations. And in contrast, I would mention Poland with its diversified economy and larger market size, maybe less vulnerable to the impact of lower export demand, while Poland also has an automotive industry. Its economy benefits from greater diversification across sectors, including manufacturing and service.
Yeah. Okay, thanks. I've got two questions left, one for each of you, and then perhaps we, unless there are additional questions, we can close the session. But Jakob, just so you can prepare, I'll ask Milya first. But the question for you is, how challenges the fiscal outlook? But Milya, let me come to you for a banking question. Look, I think you kind of covered some of this in your earlier responses. But let's call it a sort of general closing statement. And the question is this: what are your general expectations for banks in the CEE region this year?
Let's say we believe CEE subsidiaries are well placed to overcome risks this year. This is given anticipated drops in lending rates and improved loan supply and demand dynamics driving lending activity rebound. Challenges which I already presented, so include anticipated rate cuts, windfall bank taxes, debt issuance need, although manageable cost inflation and impairments. Of course, this depends on country specific, but overall expectations that profitability will be stable, solid, however weaker than previous year. Capitalization and liquidity should remain resilient, even in several countries modestly improving. And we don't expect significant deterioration of asset quality this year, given low unemployment. Initial figures, which we already can see from a number of banks for the first quarter, they appear to underline the promising forecast.
Okay, thank you. And Jakob, perhaps you can take us to the end of our session with a brief comment on the fiscal outlook and challenges.
Yeah, so we see limited room for further rate cuts due to elevated core inflation, and this will make interest rates playing a significant role in driving budget deficits this year, but also next year. One could point to the fact that there are a lot of measures widening the budget deficits which were introduced during the energy crisis, and one could consider withdrawal them, but this will complicate rather the whole macroeconomic scenario. So for instance, as an example, Poland's CPI inflation in April rose to 2.4% year on year, up from 2%, and this was largely attributed to the reinstatement of a 5% VAT rate increase on food. So to conclude, this will complicate the fiscal influence on inflation, will complicate the budget management and presents a trade-off. So reintroducing certain taxes or abolishing price caps may reduce budget deficits, but could lead to higher prices, thus fueling inflation once again.
Yeah, absolutely. Good. Okay, on that basis, I think I've got no more questions, and we've kind of reached our time anyway. So let me close the session here. Milya, Jakob, thanks so much for your presentation and for answering those questions. Thanks to our viewers for watching. We did go back and forth a bit between banking and macro, but as there's so much connectivity between them, I hope it kind of made sense. And so we will come back and do these sessions as appropriate from time to time. And please keep an eye out for our output on which comes out on the website, both the ratings news and the research. And this will be made available also on social media a bit later on this afternoon. And I did promise that I would show you how to download the presentation deck. Hopefully if this is going to work, if you click on apps at the bottom of the screen and then click on handouts, it's not there. So best plans. So we will circulate the presentation to those who have signed up. And so let me say thanks again, and it's goodbye from us.